The CAPM and the SML introduces the Capital Asset Pricing Model, CAPM, and the Security Market Line, SML, two foundational concepts in modern finance and portfolio management within the program. The CAPM explains the relationship between systematic risk and expected return for individual securities and portfolios. It builds on modern portfolio theory by assuming investors hold diversified portfolios and are compensated only for systematic risk rather than diversifiable risk. The model provides a framework for estimating the required rate of return on investments based on their sensitivity to market movements. CAPM remains widely used in asset valuation, portfolio management, corporate finance, and investment performance evaluation. A central principle of CAPM is that investors require compensation for both the time value of money and exposure to systematic market risk. The risk-free rate represents compensation for delaying consumption without assuming investment risk. Additional return above the risk-free rate is called the market risk premium, which compensates investors for bearing systematic market uncertainty. The CAPM formula states that a security's expected return equals the risk-free rate plus its beta multiplied by the market risk premium. Beta measures the security's sensitivity to overall market movements. Consequently, securities with higher beta values are expected to generate higher returns because they expose investors to greater systematic risk. The topic emphasizes that CAPM relies on several simplifying assumptions. Investors are assumed to be rational, risk-averse, and focus solely on maximizing portfolio utility based on expected return and variance. Markets are assumed to be efficient, frictionless, and free from taxes or transaction costs. Investors can borrow and lend unlimited amounts at the risk-free rate, and all investors possess identical expectations regarding future returns and risks. Although these assumptions may not fully reflect real-world conditions, the CAPM provides a useful theoretical framework for understanding risk-return relationships and estimating required returns in practical investment analysis and financial decision-making. The Security Market Line, SML, graphically represents the CAPM relationship between expected return and systematic risk measured by beta. The vertical axis shows expected return, while the horizontal axis measures beta. The SML begins at the risk-free rate when beta equals 0 and rises upward according to the market risk premium. Securities positioned directly on the SML are considered fairly valued because their expected returns appropriately compensate investors for systematic risk exposure. Securities plotted above the SML appear undervalued because they offer higher expected returns than required, while securities below the SML appear overvalued because they provide insufficient return relative to their risk level. The CAPM and SML have important applications in portfolio management and security analysis. Investors use CAPM to estimate required rates of return when evaluating stocks, bonds, and investment projects. Portfolio managers compare actual expected returns against CAPM required returns to identify potentially mispriced securities. Corporate finance professionals apply CAPM in calculating the cost of equity capital for business valuation and capital budgeting decisions. The model also supports performance evaluation by helping distinguish returns attributable to market exposure from those generated through manager skill. Although alternative multi-factor models have emerged, CAPM remains an important benchmark because of its simplicity, intuitive logic, and widespread acceptance within financial practice. Overall, topic demonstrates that the CAPM and Security Market Line provide a systematic framework for linking expected return to systematic market risk. By focusing on beta as the relevant measure of risk, the model reinforces the principle that diversified investors should only be compensated for unavoidable market exposure. The SML visually illustrates how securities should be priced according to their beta and required returns. While CAPM relies on simplifying assumptions that may not fully capture market complexity, it remains one of the most influential models in finance. For CFA candidates, understanding CAPM and the SML is essential because these concepts underpin portfolio theory, asset valuation, capital budgeting, and professional investment analysis.